Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics. And as is normal on Jobs Friday, I have three of my colleagues. We've got Ryan Sweet, the director of real-time economics. He's ready to go, I can see. And Mr. Dorides, Dr. Dorides, Cris Dorides in the office and looking dapper as usual.
I think we have the same outfit here.
Oh, yeah, I was going to say we kind of look alike, but you look so much better than I do. So I'm not even in your league. But glad
so
that you noticed that. Yeah. We both have a dark kind of sweater on, kind of with a zipper in the front here. So what was I going to say? Oh, you're the deputy chief economist. Very good. And we've got Marisa DiNatale. Marisa has been with us on a number of these Jobs Fridays, a great labor market economist in her own right from the Bureau, formerly of the Bureau of Labor Statistics. We grabbed her from BLS, and good to have you, Marisa.
Thanks, Mark.
Good to have you all aboard. So obviously Jobs Friday here we are talking about the jobs numbers for the month of March. And Ryan, take it away. What's your takeaway from the report?
Well, there's nothing really to complain about. It was another really solid report. Job growth in March rose 431,000, a little bit less than what the consensus expected, but still.
No, wait, it was 435,000, wasn't it?
Was it 31?
431.
Oh, 431.
I stand corrected.
You're throwing me for a loop there, trying to catch me off my guard.
Just testing you.
Right, because Mark never gets his numbers wrong, right?
I just wanted to make sure you had the courage of your numbers. So
yeah, okay. So job growth was broad-based. I think there was only two major industries that saw a slight decline in employment. That was transportation, warehousing, and utilities. But overall, job growth over the last 6 months is averaging close to 600,000 per month, which is very, very strong. We still have ways to go. I mean, the unemployment rate came down. It's the job market's tight. I mean, the unemployment rate came down to 3.6%. We're close to where we were pre-pandemic. I think the low pre-pandemic, right around 3.5%. So we're getting there. My favorite number, prime age employment to population ratio.
Yeah.
So that's 25 to 54 as a share of the population, rose from 79.5% in February to 80% in March. That's
up a percentage point, right? In 2 months.
Mm-hmm. So if we keep this current pace going, we could be 81.5% on the prime age employment to population ratio by the end of the year. So that's a good indication. The job market's doing really well. I mean, my takeaway is that it's good, but it's too good. We need this has got to slow down, or we're going to be in a world of hurt. I mean, the economy is going to overheat, Fed's going to panic, and we're going to be facing a recession.
Okay. Before we get there, though, let's just round this out. So, let me ask you. Up until a few months ago, you were kind of saying 80% on the prime age 25 to 50-year-old employment to population ratio. Your favorite measure of kind of the state of the labor market and where it is was consistent with full employment. We're now at 80% on the nose. Are we at full employment?
No, we're close. We're very close. So I think 81.5% was what we saw late 1990s, early 2000s. I think we can get back there. And that would probably be, that would be a slam dunk that we're at full employment. But right now, I think we're close. We're barreling towards it.
Are you moving the goalposts?
That's what I thought.
Moving it just a little bit.
Yeah. Okay.
Because employment's still 6 million below where it would be if the pandemic didn't occur in the recession. So,
maybe not, right? Because
trend job growth was around 190,000 per month pre-pandemic. So if you just extend that, we'd be 6 million higher than we are today.
Although I would throw out that we were at an inflection point for job growth, given the slowing in labor force growth that was going to happen anyway. And we probably would have been, if you remember the forecasts, and there's still a forecast, but go back to the forecast pre-pandemic for now, we were saying kind of break even in monthly employment growth, meaning consistent with stable unemployment, was something like 100K, not much higher than that. But okay.
But even if you assume 100K, we're still, a little bit lower than where we should be. Yeah. Not that we'll make that up pretty quickly in the next few months.
Right. Okay. Anything else on the jobs numbers you want to point out?
Labor force continues to increase. It was up more than 400,000 in March. this year alone, we're up over 2 million. So that's an encouraging sign that people are coming back into the labor force.
Right. Now the participation rate, which is another kind of barometer of, whether you're at full employment or not, that ticked up to 62.4%. But that's still well below where it was pre-pandemic. It was over 63%. I think 63.5, I think, wasn't it?
Yeah, we won't get back there.
We won't. Why?
No, because of demographics. We have an aging population, people retiring. We're not going to get back to 63% on labor force participation. That's why prime age employment to population ratio is much more important in telling.
Yeah, I mean, I look at that participation rate. I think we can get at least a half a point, right? Back.
Oh yeah, we'll close the gap. I just don't think we'll get all the way back.
But a half a point would be consistent with your point that we're not quite at full employment, but we have still some room to go. So a half a point on the labor force, I think that translates into what, 1 million, 1.5 million jobs. So that says what we could add in addition to what you typically would get to get back to full employment. So that's
about 3 months.
About 3 months.
This current
right.
This current pace is 3 months of job gains.
And that sounds about right to you. 3 months. That would be April, May, June. If I told you June full employment, that feels about right to me.
Yeah, sometime this summer, I think we'd be at full employment.
We'll get there.
Okay. And that's when we would get back to recouping all the jobs that we lost during the pandemic. So it's about, if we're adding about 500,000 jobs a month, then by June, July, we're back above the employment level in February 2020.
And that's the payroll survey you're talking about.
That's on the payroll side, yeah.
I think on the household survey, the payroll survey is a survey of business establishments. The payroll survey, which is the basis for the unemployment rate and participation rate and those things, I think that's already pretty close to being back. I think it's within a few 100,000 of getting all the way back to where we were pre-pandemic. Can check, but I think that's the case. So Marisa, did you want to add anything to Ryan's perspective description of the jobs numbers? What do you miss?
No, I think he got all the highlights. I mean, we're seeing labor supply kicking in. Participation rates were up among most of the major demographic groups. Unemployment rates were down among most of the major demographic groups. Job growth was broad-based, not quite as broad-based as it was last month. I think last month, the diffusion index, which is the percentage of all the detailed industries in the payroll survey that were adding jobs or staying the same, was up in the 80%. Now it was like in the 60s. So, but that's still very broad-based. I mean, over about 2/3 of industries are adding jobs or at least not losing them. So yeah, it's hard to find anything bad in this. Average hourly earnings were up. The work week was flat. So hours were about the same as they were previously.
I think hours per work per week, that did decline. I think that
that fell a little bit.
It's
barely
10 minutes or 6 minutes or something like that. Yeah.
Hey, that 6 minutes adds up.
Yeah. It doesn't move. Yeah. Okay. All right. So anything in the bowels of the report that was a blemish that kind of made you scratch your head or make you think about what the message is in that? Anything you saw? Doesn't have to be. I'm just asking. That's an open.
No,
that's what they
not
call
really.
in the moderating biz an open-ended question. See how good I'm at this? I'm really pretty good.
Yeah.
Like, tell me what I'm just saying, what didn't I ask you?
Daycare employment was up.
Huh?
Daycare employment rose.
Oh, did. That's a good sign.
It's still well below where it was pre-pandemic, but we're moving in the right direction.
Key to participation, right? Because you have a lot of young women with young children or I should say women with young children that can't get back in because they have daycare problems. Yeah. Okay. All right, Cris, anything you wanted to point out?
A couple things. One thing that struck me was there was this phrase repeated a couple times in the report, little different from its February 2020 level. So many of the indicators, as you get in further into the bowels of the report, are back to where they were or pretty close to where they were pre-pandemic. So it does indicate that it's fairly broad-based, this employment recovery. In terms of
so
other,
I missed that. So you're saying in the somehow I missed that. So in the BLS language, when
yeah,
they describe it, the report, they said back to February 2020 levels.
yes, a level different. Blah blah blah. Let's see. For example, number of permanent job losers is at a level that is little different from its February 2020 level, right? And they
Interesting.
repeated that language for a number of the different indicators. So that just kind of stuck in my head reading it. One thing that did stick out was there was a slight decline in the number of workers in oil and gas exploration, which seems
saw that.
counterintuitive, right? So not a whole lot, right? We're talking like, I don't know, 400 jobs or something, but still you would have expected it to go the other way.
Yeah. So maybe seasonal adjustment though. I don't know.
Could be. We did see there was a larger gain in refining though, petroleum products, right? So exploration may be down, but you do see some job gains in actual transformation of crude, refining of crude.
Right. Okay. Yeah, I think you guys covered it. I guess the wage growth, I really don't like using the wage numbers from this report because it's so messed up by the mix of jobs and
I
occupations.
think you said it best. They're worthless.
Yeah, they're worthless, but you guys still talk about them, right?
Yeah.
I mean, so we're up year over year 5, 6, I think. So, and if you look at all the other wage measures, the ones that I think are better, like the Atlanta Fed wage tracker or the employment cost index, that feels consistent, right? Somewhere around 5, 6%. Is that right, Marisa? Is that roughly right in terms of wages?
Yeah, they're all around 5.5, 5.6, 5.7, something like that.
Which is strong, but not inflation. So consumer price inflation, I think almost 8%, right? It's through February. So right now, workers are getting big wage increases, but they're not keeping pace with inflation. So their so-called real wage, their nominal wage growth less inflation is negative. So they're kind of falling behind here. Yeah.
Unless you work in leisure hospitality, then your
Exactly.
wages are up like 15% over the year.
Yep.
Oh, is that right?
Yeah.
Okay. And that's where the wage growth has been most pronounced. And if you look at the Atlanta Fed wage tracker data, it does suggest that it's the strongest wage growth is low wage workers in those high contact industries that got nailed during the pandemic. They're scrambling to get people back into their seats. There tend to be younger folks with lesser skills and education. That's who's seeing the biggest wage increases. In fact, if you believe the wage tracker data, says that high wage workers are, they're not seeing much of a wage acceleration in wage growth at all. Pretty consistent with what it was pre-pandemic. Yeah.
It's also the low income households. So those that are seeing the strongest wage growth are the ones being hurt the most by high inflation. So that's, kind of cushioning the blow.
Yeah. Hey, one thing I do want to talk about what this all means for monetary policy in the Fed, because that's top of mind. But before we do this, Ryan, you've been doing some pretty good work on trying to understand the causality, the relationship between wages and prices. So what's driving what? And are they both, obviously there's a great deal of concern, and this goes to monetary policy, that we're going to get into this kind of self-reinforcing wage price spiral where workers see their cost of living rise, they demand higher wage growth from their employers. Employers then provide that, pass that along in the form of higher prices, meaning inflation, and you get into this kind of self-reinforcing, very vicious kind of cycle that the only way out of that is the Fed breaking it, and that means, recession in all likelihood. What's your research show you on that dynamic? How's that playing out right now?
It's actually the opposite. So we have a price wage spiral where inflation is causing wages to increase. So the causality actually runs just one way: inflation causing changes in wages. So that's still a concern. I mean, that's still inflation, like it's causing inflation, but it's less of a problem, and things that we lose less sleep over is that it's not a wage price spiral that kind of gripped the economy in the late 1970s, early 1980s that caused the Fed to really clamp down on tightening monetary policy to break inflation's back. Right now, it just seems inflation is driving wages currently. Now that causation can change. I don't know, what would trigger it or when, but as of right now, it's less concerning to me that inflation is driving wages higher.
And that is consistent with kind of this group's thinking around what's causing the proximate cause for the higher inflation, and that is the pandemic effects on the supply side of the economy, supply
energy.
chain disruptions.
Yep.
The labor market disrupt. People are sick or fearful of getting sick, so they don't go to work. So it's on the good side of the economy where labor costs are much less important in terms of driving price increases. That's where we're seeing inflation has picked up pretty much across the board, but that the most significant acceleration has been in the good side, vehicles being the poster child, and energy prices, that kind of thing. So what you're describing is consistent with that kind of explanation for what's going on here.
More than half of our inflation problem. So we have 8% inflation, give or take. 4 percentage points of that is energy and supply chains. So a good chunk of the inflation problems are isolated to those two components.
And of course, desirables too. So you're really talking about the 6 percentage point acceleration in inflation. 4 percentage points of that is due to these factors you just described.
Correct.
Yeah. Okay. Hey, Cris, Marisa, any observations or thoughts on that dynamic, wage price dynamics that we just described? Just curious if you have any thoughts on that. Have you done any work in that area?
I think that's right. But as Ryan said, things can change pretty quickly. That's the nature of the spiral, right? So you could see prices being influenced by the higher wage costs in short order.
Yeah. What do you think? Oh, sorry, go Marisa. Go ahead.
I was just going to say, one way of gauging that is to see how broad-based wage gains are. And because we still see this huge disparity among wage growth in these traditionally lower wage industries that were really hit by the pandemic compared to, professional service jobs or jobs that were kind of insulated from the pandemic because people could keep their jobs and work from home, it does suggest that there's still that catching up from the pandemic bounce back that's happening, right? So everyone's not getting 10% wage increases. It really is very isolated to a few industries at this point. And also the other thing the Atlanta Wage Tracker tracks, and I think you've mentioned this before, is the difference between people that switch jobs, get new jobs, and people staying in their jobs, right? And you see one of the largest gaps between those two now. So people that are getting new jobs and switching jobs and able to negotiate new wages are getting significantly higher wage gains than people staying in their current jobs. That's always the case, right? That's always how you get the biggest wage gain, is by leaving a job and getting a new one. But that gap between the two is larger than it's been in a very, very long time.
Oh, I didn't notice that.
Yeah. It's maybe about 1.5 percentage points higher for people that are switching jobs.
And just to remind everyone, the Atlanta Fed Wage Tracker, and you can Google it, go Atlanta Fed Wage Tracker, you'll go right to it. It's kind of nice little tool there. You can cool data, very timely through February of 2022. That tracks the same worker through time. So it's controlling for those mixed problems that I just articulated was a problem with the average hourly earnings data that's in today's jobs number. So why it's so useful to look at. Okay. Can you see anything in the report that might connect back to the Russian invasion of Ukraine? I mean, Russia invaded Ukraine, back, I think it was now late February, right?
Yep.
And of course, there was growing evidence that they were going to do that for at least a few weeks before that. And of course, the March employment data we're looking at today was based on a survey done by the BLS kind of mid-March. So that was now well into the Russian-Ukraine. We had seen oil prices spike at that point, and there's already a lot of concern about what Russia-Ukraine means for global commodity markets and the global economy. Anything in the report at all that gives you a sense that, businesses are worried about Russia-Ukraine and its impact on their business and on their hiring or layoffs? Anything? I didn't see it. I
didn't see anything.
Nothing. Yeah. Marisa, Cris, did you guys see anything at all? No. Okay.
Even employment in remember we had that big decline in auto manufacturing employment last month, and it didn't fully reverse itself, but there was an increase in auto manufacturing employment this month. So these sectors that are really sensitive to, consumer spending or consumers substituting one good away from another, high gas prices, that doesn't really seem to be showing up in a compelling way.
Yeah. Okay. Cris, you're a maven of LinkedIn, aren't you? I think you're well known on LinkedIn.
Well known. Yeah.
Isn't he? Oh, you're not on LinkedIn, are you, Ryan?
No, I'm on there.
Oh, you are? Yeah.
Yeah,
So
I mean, I see
I hear Cris
everything
is all
pops
over
up.
LinkedIn.
Yeah,
Chris is a
every day.
frequent poster.
Yeah, my
He's a
phone
frequent
throughout the
poster.
day just beeps
Yes.
because Chris is posting things on LinkedIn.
He's tagging you and stuff.
Yeah, it's
There
unbelievable.
you go. Yeah. Nothing else to do. So,
No, I know.
Don't say that. What was I going to say? Oh, so I was listening to this researcher from LinkedIn, and they can track like real time kind of engagement from people on the LinkedIn site, and with regard to looking at job postings and applying for jobs and that kind of thing. It's global. It's all over the world. And she was saying that on the day of the invasion, I guess going back to late February, and you look at engagement in the U.S., there was no change. The same level of engagement in the day before and the day after. No one was really, at least in terms of job search, paying any attention to Russia, Ukraine. But very noticeable effect on engagement, job search in Europe, which it makes, I guess, perfect sense, but is interesting. So it does seem to suggest that Russia, Ukraine is going to have a much bigger impact on the European economy than our economy. And that, again, that's what we've expected, but it is interesting to see that it's actually already showing up in anecdotal data. And I'm sure we'll see it in the economic statistics soon. So very interesting.
Yeah, Chris has got to he's got to get off LinkedIn. Might improve his employment forecast.
Do a little bit more modeling. Is that what you're suggesting?
Oh, yes, take a little more time, dig into it.
Ouch.
Right.
Ouch.
Mm-hmm.
That's
Yeah, he's tough.
Sorry, Chris. We're all
yeah.
Remember revisions. Revisions are coming. So
exactly. Good point. Okay, so let's now talk about what all this means for monetary policy. And
actually, I don't think you mentioned the revisions.
Yeah, that's a good point.
But if you add in the revisions to the previous couple months, then you're over 500,000 jobs, right? So we had 431 in March, but then January and February combined were another 95,000 jobs.
Yeah.
So I think that's a victory.
I think so.
No, I think
for those of us who said there'd be over 500,000 jobs added.
Mm-hmm.
Yeah, no, that's a great point. And we've been consistently getting upward revisions each and every month for the past more than a year, right? I mean,
the January job gain is over 700,000 with these revisions alone.
Yeah, pretty amazing. Okay, so let's talk about it. When obviously really strong job growth, rapidly falling unemployment, rapidly increasing employment to population ratios, very strong wage growth. I don't know. What does it mean for monetary policy? I mean,
watch out,
right?
Yep.
I mean,
green light.
Yeah.
Yeah, they're close to breaking glass. Like that panic button, they're about to hit it.
Yeah, and what does that mean exactly?
Aggressive rate hikes. So 50 basis points in May, 50 basis points in June.
So 0.5 percentage point in May, that'd bring the funds rate target, the key rate they control, to 75 basis points, 0.75 percentage point. Then you're saying another 0.5 percentage point in June when they meet in
Correct.
June. Okay, that makes you at 1.75%. And then what?
And then 25 for the remaining meetings this year. So we'll end the year 2.25%, 2.5% on the Fed funds rate,
which is pretty close to the so-called, I guess, neutral rate, R star, the equilibrium rate. Where everyone kind of thinks the funds rate should be in the long run if everything is functioning properly.
Yeah, and they won't stop there. Yeah, they'll go higher. So then that puts monetary policy restrictive. So when you hit the neutral rate, it's kind of, it's neither stimulating or slowing down the economy. But when you go above that, that's when, the Fed's pushing hard on the brakes.
Yeah. So that's the so-called terminal rate. That's where they ultimately push the funds rate to at the
Mhm.
peak. And what do you think that is in this rate cycle?
Well, the Fed's own forecast, their summary of economic projections, have it 2.75. So
So
I
just
think
above
that's
neutral.
just, yeah, I think we probably get to 3.
Okay. So is this what you think they should do?
No,
This is this is what they will do.
right. I mean, our job in forecasting is what the Fed will do, not what they should do. I don't think
Although
they should panic.
you always say that, but the way I think about it is what should they do? And then because they generally do what I think they should do, that's therefore what they will do. It's rarely different. Is it different this time? I mean, are you saying what they should do and what they will do is different?
Yeah, just like in 2015, I didn't think they should have raised rates in 2015, but they did. So
So they're going to make a
Okay.
mistake.
yeah, they're going to make a mistake by
Interesting.
going too aggressively
Okay.
because
Okay.
they're
So
reacting to. I mean, they described the labor, like Powell described the labor market. So Fed Chair Powell as unhealthy. Like that's panic to him. Is yeah, we have high inflation, we have an unemployment rate that's plummeting. So they're going to really slam their foot on the brakes.
okay. So so you're saying what they will do is half a point in May, half a point
Mhm.
in June, quarter point rate hikes after that until they get to
Right.
2.75% sometime in what, early 2023?
Correct.
And that will be too much, meaning what does that mean exactly? What does that mean too much?
Means the economy is going to
Recession?
come. Well, it won't get close. I mean, it could be.
Okay.
I mean,
All right. So you're saying if they do that, if they stick to that
yeah, there's no
script, which
soft
you
landing.
think this, then it's going to be hard to have a soft landing.
Correct.
Okay. All right. Interesting.
All right.
What
So
will they?
if you were sitting on
What,
the Fed, what would you do?
yeah.
And that would be interesting to see what Marissa and Cris would do.
Well, of course, I don't have to put in stone what I'm going to do for the next year because I'll adapt and adjust. The only thing I have to make a decision about right now is what I'm going to do at the next meeting, right?
Mhm.
And I
So would
think,
you go 50?
yeah, I absolutely, I would raise it a half a percentage point. And the other thing I would do is I would announce that I'm going to start to allow my balance sheet to wind down. So as everyone knows, the Fed up until March was buying treasury bonds and mortgage securities. That was quantitative easing, bond buying to try to bring down interest rates, long-term rates. They've stopped buying in March, but my sense is by May, they'll say, okay, let's allow the treasuries and mortgage securities on my balance sheet to run off as they mature, or in the case of mortgage securities, they might prepay, although I don't expect a lot of that in the current rate environment, and allow the balance sheet to come down, which is kind of adding to the rate increases. So
Mhm.
I would do both those things, what you call passive quantitative tightening and half a point increase in the funds rate target.
Well, that's what they're going to do. Yeah, they're going to
Okay.
announce both. Yep.
Oh, that's okay. So that's what I was saying.
Mhm.
Usually, what I think they should do, they will do. It's rare. Okay. So, but you wouldn't do that if you were on the FOMC
No, I'd go
at the May meeting?
25. I'd go 25 and let the balance sheet run off. I'm afraid it's too
Interesting.
much all at once, especially
Yeah.
with the yield curve flat as a pancake. I mean, I'm concerned.
Right. We'll come back to that in a second.
Mhm.
Cris or Marissa, any different perspective on this, or what's your view?
A
Cris, you
short
go
term,
ahead.
I agree on the short term, certainly 50. And I would actually, if it was me, I would start to unwind the balance sheet now. Why wait?
Yeah.
Right? You
Why
actually
wait?
send even a stronger signal that, we're really concerned about this. I don't think they're going to I don't think they're going to be able to be quite as aggressive later in the year. I think some other factors will pop up here. We still have other risks to growth. So I don't think we'll get all the way to Ryan's trajectory here, but certainly the path is upward. It's just a question of speed.
Right. I forgot to ask Ryan. So the Fed in their forecast says the terminal rate, the peak funds rate is going to be 2.75. What's your terminal rate? What?
Yeah, right around there. I
Right
think they'll
around
get
there.
up
Okay.
there.
Just
I
get there
mean,
more
Cris has
slowly.
a great point. Like the markets could push back. And I mean, if you look at the market's implied path, they're already pricing in a policy misstep. They're penciling rate cuts towards the end of next year and into early 2024.
Hey, can I ask you about that? Because I got a tweet, by the way, at Mark Zandy.
There
I'm
you
just
go.
saying, at Mark Zandy. And Ryan, what's your Twitter handle?
At realtime _
At
econ.
real time. Okay, so I had a Twitter follower tweet a question, and they said, "You guys talk about these probabilities of the Fed doing X, Y, and Z. So now you're saying we're going to have a 0.5 point increase in the funds rate target at the May meeting. Can you tell us what's the market probability of that happening? And can you just tell everyone how you arrive at that? How do you know that?"
So there's something called Fed funds futures where it's investors putting money where their mouth is and buying what the futures contract for each FOMC meeting for the rest of this year are, and out of that price you can back out the probability of different outcomes at the FOMC meeting. So with the May contract, currently where it's priced at is implying a 73% probability of a 50 basis point rate hike.
And that's in the month of May.
Correct. That's the May contract for the Fed funds futures.
May contract. 73% probability. Oh, I'm surprised it's not higher than that. 73% probability. Okay. What about June? Do you know that offhand?
I don't. I can look it up.
No worries. I just curious.
It's probably north of 50.
Yeah. Okay.
So a good rule of thumb is 70%. That's kind of like historically, leading up to FOMC meetings, if the probability of 25 or 50 basis point rate hike is more than 70%, the Fed usually follows through because they don't want to surprise markets. So as May gets closer, if the probability of a 50 basis point hike is north of 70%, they're going to go 50 basis points.
Right. Okay, Marisa, you're now on the FOMC. You're a Fed member. What would you do with regard to setting of the policy? The decision is what's going to happen in May at the May meeting.
Yeah, I mean, I think they have to take it meeting by meeting because things are changing so rapidly. If nothing major happens between now and May, then 50 basis points seems reasonable. They have so much to play with on the balance sheet that I would maybe do more there. And I wonder if letting the balance sheet run off has a different psychological effect on the market than announcing an outright rate hike. I don't know if you know the answer to that, Ryan, but they've got such an enormous balance sheet. I think they can certainly wind that down, which they haven't done yet, right? But announcing a rate hike might have a different effect on investors and markets in general.
Yeah. Well, I think I think, correct me if I'm wrong, Ryan, but the evidence suggests that the most significant impact of the Fed's balance sheet policy on financial conditions and on the economy is through the signaling effects,
correct,
not just so much the actual purchases. So they're using that as a signaling mechanism to investors that, hey, I'm going to be very aggressive in easing or tightening, and that's really where the juice comes from mostly, I think. Is that right, Ryan?
That's correct.
Yeah.
Yep. You can see it, like when you kind of can do event studies looking at the impact on interest rates or financial market conditions when they make announcements versus actually following through with changes to the balance sheet policy. And the largest impact is when they make these signaling through the signaling channel.
Yeah. Hey, one thing that no one's talking about, and I'm wondering if they should, is the Fed has another tool or tools, and that is regulatory policy, right? I mean, one thing I've noticed is in the housing market, rates have jumped in anticipation of what the Fed's going to do and the higher inflation. So mortgage rates, correct me if I'm wrong, Cris, is on the Freddie Mac 30-year mortgage is now 4.65, I believe, last week. That's up. That's still low by historical standards, but that's up a lot in a very short period of time.
Yeah.
Market feels like it's starting. Housing market feels like it's starting to freeze up because these higher mortgage rates are conflating with the high house prices and affordability is getting crushed. And you're starting to see lenders, and this is completely typical, they say, "Oh my gosh, I can't originate loans to keep things going." They're starting to lower their underwriting standards. They're becoming more aggressive in accepting borrowers with lower credit scores or higher debt to income ratios, higher loan to value ratios. I guess the first question to you, Cris, is: have you observed that yet? Are you hearing that? Is that something that's going on?
I haven't really heard much of that happening, right? So it's possible.
Yeah.
Certainly with refinance volumes going off a cliff, you certainly want to keep your operations, but there's just not, the number of sales is also quite low as well, right? Because of the limited inventory. So it's possible, but I don't know that we'll see that dynamic play out this cycle just because of what happened last time around. So.
Right. Well, I guess I bring that up because, that dynamic of lenders kind of easing at the same time the Fed's tightening is pretty classic. And that generally creates problems because some of that bad lending, that weaker underwriting, gets caught in the subsequent economic slowdown or recession, and it exacerbates the recession and downturn. And, maybe the Fed should use put on its regulatory hat and say, hey, for example, they could, juice up capital standards for banks, right? And say, hey, you need to hold more capital because you're taking more risk here, or at least we're concerned that you're going to take more risk, or simply, I want things to slow down. I want things to slow down. But what do you think? That's kind of like a cudgel when you need kind of a scalpel, I guess.
Possible, but the banks are overcapitalized, right? I expect them to sail through CCAR this year, the stress testing exercise, no problem. So they would really have to ramp it up substantially, and I don't know if that's on the agenda. So I do think that they'll be mindful. I don't think they're going to let things loosen up here significantly, but I don't see them going down that route necessarily. I think the rates themselves are going to be enough.
Yeah. Yeah. Okay. All right.
Yeah. The Fed puts out, every January their long run policy objectives, and they reinforce the idea that the Fed funds rate, the target Fed funds rate, is their primary lever. So it's to Marissa's point about using the balance sheet, like they'll use it, but the Fed funds rate is their primary tool. So they're going to lean on that pretty heavily.
I guess the other argument against the Fed actually turning to regulatory policies, they don't have a person on the Fed to manage supervision, right? So there's a vice chair of supervision. They had the Biden administration had nominated Raskin to do that, and she was unable to get through Congress, and so that position is still empty. So that might make it more difficult to use that as a tool, I think, in the current environment. Okay. Hey, you mentioned the yield curve, Ryan, because you were saying, look, one reason why I think the Fed might be overdoing it here and raising rates too quickly is the shape of the yield curve. It's gone flat. Do you want to just describe what that is and what's going on there? And this goes back to another question a person who tweeted to me asking, what kind of indicators should we be watching to gauge where the economy is headed? And the thing that comes to my mind immediately is the shape of the yield curve.
Yeah, so the yield curve is the difference between long-term Treasury securities, so the 10-year Treasury yield, versus a measure of short-term interest rates. So right now, all the attention is on the difference between the 10-year Treasury yield and the 2-year Treasury yield. So that's one measure of the yield curve. And that temporarily inverted earlier today, and I think it inverted earlier this week. An inversion, typically is an indication that investors are worried about the economy's near-term prospects. The yield curve has a pretty good track record. I'm skeptical of it. A pretty good track record in predicting recessions. But this inversion that we've gotten today and earlier this week is a soft inversion. It's a blip. You need a hard inversion. Probably 30, 60 days of a yield curve being inverted. Also, the 10-2 has sent false signals. The best measure of the yield curve is the 10-year minus the 3-month Treasury bill yield. But that's being anchored by the Fed funds rate. That's keeping that 3-month Treasury bill yield really, really low. That's going to start to increase and flatten out that yield curve as the Fed begins to dial back on or begins to increase interest rates going forward. So all in all, the yield curve is going to continue to flatten out, and that, the Fed has the yield curve on its mind because, again, its track record in predicting recessions. And when the Fed is tightening and the yield curve inverts, that's a recipe for an economic downturn.
You said it's falsely predicted recessions? When?
Yeah, the 10-2 has.
Oh, it has? When? I didn't realize that.
1960s.
Oh,
I want to say
yeah.
67 or 69.
Yeah. Okay. You're really stretching, buddy. You have to go all the way back to
Hey,
1967.
it's
Jeez
a false signal. It's not perfect. It's not perfect, Mark.
Okay. Yeah. Was it a hard inversion back in 67? Yeah. Okay. Because I tend to only look back to like the late 70s, but since the late 70s, I don't think it's ever falsely predicted a recession. I don't think. Right, Chris?
Well, I mean, you got to put an asterisk on the 2020 recession. There was no need for
I don't know. Why?
A pandemic?
Yeah.
The yield curve did not predict a pandemic. That is false.
No, but it was predicting a recession, and I think
if
there
it
may
wasn't for
very
a
well have been a
pandemic,
recession.
there would not
in
have been a
2020.
recession without a pandemic.
Not because of the pandemic, but because the proximate cause would have been the trade war. But it was signaling something. The pandemic just came along. No? Okay.
No.
All right. I think so.
We'll never know.
We'll never know. That's the problem. We'll never know.
This could be the end of the podcast.
Why?
The yield curve.
What do you mean?
It's going to cause some tensions between the three of us.
Oh,
This is going to cause a lot of. Marissa's going to have to chime in.
The podcast is.
It will survive.
Yeah.
Oh.
Oh, yeah. This podcast, right? There's no way they break us apart. Not
Like
the yield
tension.
curve.
People are here for the tension.
Yeah, they're here
That's
for the
right.
tension. Yeah, they're here for the tension. Okay, let's play
That
the
inversion
game.
in
You thought I forgot about. Oh, sorry, Chris. You wanted to say something?
I was going to say the inversion in 2019 was September. It wasn't that large and it wasn't that long.
No.
Right. So
I don't even know if it qualified as a hard inversion. I don't know. Did it actually invert for?
All right, so there's another false alarm.
it was I think it was like a week. It wasn't.
Yeah,
it was
no, that's what I'm
short.
saying. You need at least a month or two, I think, to get some kind of signal.
So maybe that's a yellow flag,
Yellow flag.
inversion. And you're saying the red flag inversion is when it's
more
than 10 basis points.
A hard inversion.
Hard inversion.
Yeah.
Okay.
So, but with all the caveats though, wouldn't you agree that if you had to look at one indicator, you had one indicator to pick to try to gauge which way the economy is going in a period like this, when you're trying to gauge whether it's going to go into recession or not, would be the yield curve, right?
I'd actually go with, and we'll see what Marissa says about this one, the unemployment rate. I know it's backward looking, but historically, if the unemployment rate increases by 25 or 30 basis points on a 3-month moving average basis, it's over. A recession always follows. It's not, there's no false signals there.
Fair, but that gives you no warning, because once that happens, you are actually in recession.
Right? Exactly.
Yeah.
But I'm just saying, if you want to try and test it, measure, that's it.
Okay. So just, again, because the listener asked, just describe that other measure you just mentioned.
The unemployment rate?
Yeah.
Yeah. So when on a 3-month moving average basis, if the unemployment rate increases by 25 or 30 basis points, a recession always follows, because it's the self-reinforcing cycle kicks in. You see unemployment going up, people start to get pessimistic. They cut back on spending. That leads to more layoffs, and that drives the unemployment rate even higher. So you just kind of go round and around.
And that also is like consistent with the observation that the lower the unemployment rate goes, the more likely it's going to rise.
Right.
And when it rises, watch out, because this bad dynamic takes hold.
Yeah, that's why I watch jobless claims.
Yeah.
Because that gives you kind of an early warning on what the unemployment rate is.
Okay, there's a third one. You're really good at this.
We can spend hours.
I know we could. Yeah. Okay. All
right.
But
if you had to pick one, it's the yield
curve. If you had to pick one, he's saying the unemployment rate. I still say the yield curve, but anyway.
I'll go with jobless claims.
Oh, geez. Okay. We got to play the game. You think I forgot about the game, the statistics game? So just to remind everyone, this game is we each announce a statistic. The rest of us try to figure out what that is, through questioning, deductive reasoning. We're allowed to quiz the person who put it forward. The best question, or the best statistic, I should say, is one that's not too easy, that's a slam dunk. One that's not too hard, that we'll never get it. One that's kind of related to recent performance, generally something that happened in the past week or related to the topic at hand, which obviously today is the job market. So with that as a preface or a description, Marisa, I'm going to turn to you first. What's your statistic? And Marisa, she's had a checkered past with this game, as I recall. Something about positive, negative signs. I can't.
She has a love-hate.
let's
She
let
has
it
a love-hate
go.
relationship with this game.
A love-hate
on.
relationship. Yeah.
Oh, God.
Oh, by
It's
the way,
exhausting.
by the way, this is April 1. April 2 is the first year anniversary of our podcast. The very first podcast we did was April 2nd, 2021. And Marissa, you weren't on the first podcast, but you were one of our initial podcastees, I believe.
Within the first month.
Yeah, and I
was
think
on,
it's that
yeah.
first time you were on, you kind of got the negative with the positive sign.
Right.
Okay.
Yes. A year later, and we're still talking about it.
We're still talking about it. Hey,
I
here.
guess.
Okay, I promise I won't bring that up again, but Ryan definitely will.
I will.
You know,
I will.
definitely bring it up. All right, so what's your number?
Thanks for letting me go first because I was afraid someone would steal it.
Ooh.
Okay, my number is 5.5 million in March.
Okay, labor market data
Yes.
statistic. Okay,
Yep.
in today's numbers, employment report.
Yes.
Okay, in the household survey.
Yes.
The number of unemployed.
Oh wait, that's pretty close though.
I
The
think
number
it's
of
close.
unemployed
That's
is
6.
5.6.
No, 6
5.6.
million, right? Unemployed.
No, I think it's lower than that. I think it's
I think it's like
5.7.
5.9, I think.
Someone look it up because
I'm
All right, I'll
looking
look it up right now.
5.7. That's my number.
5.5.
Okay.
It's
All right,
6.
So, but anyway, that's
Oh.
not your
It's
number.
5 point. Yeah, that's not the number. The number of
Yeah.
unemployed in March was 5 point.
Is it the number of
9.
people?
Oh,
The number of
5.9.
people not in the labor force but want a job.
You are correct, sir. That is it.
Ooh, watch out.
Yep. Good guess.
Okay, so what is
There's
that again?
It's not a guess.
So
No,
it's the number of people that aren't in the labor force but
Yep.
say that they want a job.
Right. Okay.
So the reason I picked that is because we're talking about participation rate rising, labor supply starting to kick in, the EPOP ratio coming up. I think it's interesting because a lot of the people in this category, they're saying that they want a job, but they haven't looked for a job in the last year. And that might be, they might have looked, but they may not be available to take a job, which are two of the requisites to be counted as unemployed. There's a disproportionate share of that group that are women versus men that are in this want a job group. And it's about 500,000 higher than its pre-pandemic low. So it was right around 5 million, excuse me, in February of 2020. So I think that represents more labor supply that's out there. And we've seen the participation rate in the past few months and since the start of the year in particular rising among prime-aged women. And if a lot of these women are in this want a job, but I haven't looked or I'm not available to take one right now category, that could represent, if we get down to that pre-pandemic level, that's another 500,000 people that could potentially come into the labor force over the next few months.
Can I ask you? Oh, sorry.
Yeah,
Go ahead.
Yeah. No, go ahead.
So in trying to kind of gauge how much labor supply is left before morale, what we're doing is we're kind of comparing all these numbers to pre-pandemic numbers. And I think that's reasonable. We don't have a better option. And if you do that, as you say, the number of people that are out of the workforce that want a job, that feels like labor supply, and it's 500,000 or so above what it was pre-pandemic. So that's 500,000 at the current rate of job growth. By the way, that's 1 month. We can absorb those folks. And then the unemployment rate is at 3.6, and I don't think there's anything left there really, right? Because pre-pandemic unemployment rate was 3.5.
3.5,
right?
Yeah.
So maybe, I don't know, 100, 200,000, something like that. Where else would you get labor supply, based on that kind of arithmetic that I'm doing? It's either the unemployed or I'm not in the labor force because I'm not looking. That's the number of folks that are not in the labor force but want a job. So is there any other source of supply here?
I think it's going to come mostly from people that are not in the labor force at this point. I mean, even if you look at all the other statistics around unemployment, people that are unemployed long term, like 27 weeks or less, that's actually below now, I think, where it was prior to the pandemic, or people that are losing jobs, layoffs. I mean, look at jobless claims, right, in the past few weeks. I mean, they've fallen into the extremely low territory. So people aren't getting laid off. Even the number of people that left jobs last month, according to the household survey, fell. So it seems to me it's got to be people that left the labor force during the pandemic and are starting to come back. We've even seen, we talked about the great retirement or the great resignation or whatever people have called it. There's even been some upturn in older people who had left the labor force during the pandemic coming back. So maybe these people that we thought left the labor force and said, okay, this is a good time to retire, seems like some of them are even beginning to come back a bit. So
well, I saw that statistic. It's called the exit rate from retirement. And if you look at the exit rate from retirement, it actually collapsed early in the pandemic. No surprise, but now it's completely normalized, meaning back to where you would have expected it to be without the pandemic. So it's almost like can't even look to that for any additional, unless it rises above, the trend, the pre-pandemic trend.
Right.
So I'm getting I'm trying to figure out, where do you get the people? I mean, right? I mean,
yeah,
people that are in school, people that are not in the labor force because they're worried about getting sick. Now with the pandemic hopefully winding down, they'll come back in.
So you're saying those are folks that are not in the labor force but don't want a job at this point in time.
Correct.
Because they're still.
That's where you're going to get it.
Okay, fine. Okay,
There's
some. Think of that. Yeah.
Some immigration too, right? There was just an announcement of increasing number of visas. So
you're saying the rate of underlying labor force or of a working age population is going to grow, is accelerating here because of easing up on immigration laws as the pandemic fades. We'll get more immigrants coming into the country.
Right.
That'll increase in help. Okay.
Yeah.
All right. Okay. So we've got a little bit more to go on the number of unemployed. We've got, 500,000 or so labor force, not in the labor force, but want a job. We've got folks that are probably still out there kind of waiting for the dust to clear, the dust to settle on the pandemic before they come in. We'll get a little bit more juice as immigration picks up here. And if you kind of add all of that up, we might have 1.5 million or 2 million jobs left to go before we're, tight as a drum like we were pre-pandemic. That's kind of the arithmetic, right? Okay. Right.
Yeah, and I agree. Just back to what Ryan was talking about earlier, I don't think we're going to get back to the participation rate that we saw prior to the pandemic. I mean, you'd need to get back to that participation rate with the current population. You need a couple million people to come into the labor force, and that's just given what we just talked about. Where do you get a couple million people unless immigration really picks up? I mean, that's really the marginal gain, and I don't think that it's going to be that large. Just demographics, I just don't think, just given baby boomers aging out of the working age population, I don't think we're going to get back to that.
Okay. All right, Cris, I know you need to leave in 10 minutes or so let's get your statistic.
Okay.
Yeah,
minus 274,000.
Are you sure it's minus?
I'm positive it's minus.
You're positive that it's minus.
A decrease. How about a decrease of 274,000?
Okay, there you go. And that's it's in the employment numbers.
Yes.
It's in the household survey.
Yes.
Oh, is it the number of? Is it a number of unemployed people? Is it in the unemployment?
Yeah, it's a
categories.
Decline. Yeah.
Permanent job losers.
You referred to it earlier, Marissa.
27 weeks or longer unemployed.
Yep, that's right.
Good job, Marissa.
Good job.
All right, she gets a cowbell.
That is definitely a cowbell.
She gets a cowbell.
That was good.
That was a weak cowbell, but okay.
Oh my god. I'll drop it off your house. You could now do the cowbell going forward.
Yeah. Well, I have an idea.
Mm-hmm.
We should all get together in the office and do this podcast together. That'd be kind of cool.
Office is open soon.
Mind blowing if we did that.
Yeah, Marissa, you have to fly out.
I will
Oh,
gladly fly
Marissa, you
out.
got to fly
Yeah.
out for this. All right, we'll wait
Sure.
till Marissa's on.
Next
she makes her
employment.
way out. Are you flying out, by the way, anytime soon? No
No,
plan. Oh,
no,
geez. All right. Okay.
not
We'll
to
have
sit
wait
in
a
an
while.
empty office.
All right. So what was your statistic, Chris? It seems a little
Uh,
lame to me.
It,
What?
the decline in long-term unemployed,
Oh, long term.
274,000 to, so there's 1.4 million long-term unemployed now. That's still above, about 300K above what it was in February 2020. So not quite back all the way yet, but making progress. And this is usually the toughest segment, right, to get reintegrated into the labor market. So
Can you say that again? How far away from pre-pandemic levels for folks that are more than 27 weeks unemployed? Long-term unemployed?
300K, 307,000.
307,000. So, well, and it fell 273K last month.
Yeah, 274. Yeah.
Okay. So we
So-
could be there next month or the month
Easily.
after.
Easily.
Goodness gracious. Okay.
How do you
that's a good
square
one.
that with the beverage curve? So the beverage curve is the relationship between job openings and the unemployment rate. It's so an outward shift in the beverage curve, which we have today, suggests that the labor market's less efficient, or there's structural unemployment, in the short run. So, but that's Chris's number. That long-term unemployed, which is a proxy for structural unemployed, is coming down pretty quickly. But the beverage curve is still shifted way out.
Don't
But
you
that
think
did-
that that's pandemic related weirdness with the labor force? I mean,
Maybe.
it's a supply side recession where
Yeah, I wonder if we should calculate it by industry. I wonder if like leisure and hospitality has been, the biggest outward shift in the
Mhm.
beverage curve.
This also happened after the
Probably.
financial crisis. Remember, same
Mhm.
exact thing. And we're
It
all
came back
sitting there,
in.
what's going on? What's going on? And then it just came right back into where it had been historically.
Mhm.
As things settle in. I suspect that's the case here. Okay, Ryan, what's your statistic?
All right, so I'll give you a hint. It's close to Marissa's, but all right, I'll give you three numbers.
You seem
11.
You seem a little hesitant with.
it
Yeah.
seems nervous.
I know I'm
Yeah, you
nervous
seem a
about this
little
one.
nervous. You're like fidgeting, and what.
I
the
know,
heck?
I know. All right, three numbers: 11.263 million, 5.952
Oh.
million. Oh, all right, Chris got openings. Very good.
What did
That's
you say?
11.2.
11.2 million openings. Yeah,
That's
unfilled
job openings.
positions. Yeah.
5.952 million, and then 11.689 million. They're all related.
Are they all in the JOLTS, the job opening labor turnover survey?
5.9 is hires.
The first one's JOLTS. That's it. The other two.
Oh.
are
First one,
employment numbers.
okay.
So
Okay, the
job
other-
openings is 11.2 or 11.3
Okay.
million.
What's the second one?
5.952 million.
That's the number of unemployed
Exactly. Very good.
people.
Yeah.
And then what is 11.689 million?
And you're saying it's related, is only related because it's a job statistic?
Oh, is that
They're-
U6?
Mm-mm.
11 point. Huh. It's in the household survey data?
It is.
Okay.
You got to do a little bit of a calculation.
Oh, we got to do
a little
bit of
addition.
calculation. Oh, something plus something.
Correct.
Okay. I don't know. You guys know?
Is it?
Mercy, you can get this one.
Saying I can't get this one? Is that what you're saying?
That's what he said.
Re-
No, that's what I'm
That's
hinting.
what he's implying. All right, now I got to think about this because now that's a challenge. He laid down
That's
the
the gauntlet.
Yep.
as they
The
say.
challenge has been.
I'll
I'll give you a hint.
Okay, give us a hint.
It's unemployed plus something.
Was it?
Yeah.
Is it the U6?
I got that.
Unemployed? U6?
Discuss that.
Nope.
No. Discuss that.
Earlier conversation.
I don't know. Chris, do you know?
No.
Like Chris
Is
like
it a
looking
subset of
down-
not in the labor force?
I'm
Ryan?
trying to, I'm writing. I'm trying to figure it out. I'm trying to do some math.
Is
here.
it, Ryan? Is it a subset of people that aren't in the labor force?
Yes.
Because it's close to that want a job, marginally attached. No, that's
No, you got it. It's unemployed plus those not in the labor force that want a job. So
Okay.
a lot of attention. You look at job openings, 11 million, north of 11 million, and everyone's saying, well, that grossly exceeds the number of people that are unemployed, which is roughly 6 million. But if you add in the people
I
that
see.
are not in the labor force but want a job, we have 11.7 million. So, there's not a labor supply shortage. It's a tight
Right.
labor market, but the people are there. You just got to find them.
Okay. All right. That would have been, that's pretty tough. You have to admit. Well, I guess the first one was pretty easy. And
Well, it was my statistic plus the number
Unemployed.
of
Yeah.
unemployed. Yeah.
a little tough. That's a little
You should have
tough.
gotten that one, Mark.
Yeah. Okay. Okay. Whatever you say, buddy.
No.
What's yours?
Well, I'm a little embarrassed by mine too, to be frank, because you'll never get it. But it's a really good one, and I'll give you, I'll give you a big hint. It has nothing to do with the employment report, because I
Okay.
knew all you guys would be all over the employment report, and I'd be the last to go, and I'd have a hard time coming up with a statistic.
Did you learn this number on your conference call with the New York Fed?
I did not,
Okay.
but I did. I will give you a huge hint. Huge. It is on EV, Economic View, which is the website.
Is it labor market related or not directly?
No, not at all related to the labor market.
All right. So here we go, Chris. Inflation.
All right, ready? And I'm going to give you two
BNI,
numbers.
BNI.
I'm going to give you two numbers.
Here we go.
7.4%. Ready? And the other one is 25.6%. And I'll give you another big hint. The 7.4% is the month-to-month percentage change. The 25.6% is the year-over-year percentage change. These are big numbers, right? So what do you think that number is?
All right. Is it U.S. related, or are we going?
It's U.S. It's
Okay.
U.S. And it's obviously related to inflation, and it does connect the dots back to the Russian-Ukraine invasion, I think, to some degree. That's also a big hint.
Is this
So
gasoline prices?
Gasoline prices? No, that would be too. That would be no. This is better than that. But you're in the right ballpark. Your mind is in the right place.
Is it heating oil?
No.
Was it in the ag price report that
Yes.
came out this
the
week?
Man, she's good.
Ag.
Yeah.
Wow, Marissa.
Yeah.
Ag
so-
prices. Yeah. She's
Wheat?
very good. Very good.
Or is it all ag prices?
It's all agriculture. It's prices received by farmers, all agricultural goods. So that would be crops and livestock. And in the month of February, which is I think it is February, the last data point. Let me just check. Yeah, it's February. That increase was that was crops, not livestock. But year over year, livestock prices are up 35%. Crop prices are up 17%. And this goes to lots of things, obviously, including the higher cost of fuel, which is and energy, which is key to production of agricultural products. But it's also, I think, it may be partly related to what's going on in Russia, Ukraine, because not only did that disrupt energy markets, oil and natural gas markets, but it's been a huge disruptor to large parts of the global agricultural export market for wheat, for corn, for soybeans, for sunflower oil, and fertilizer. Fertilizer is a big export, and that's been also quite disruptive. And obviously this goes to just another source of overall inflation, and I don't think it's over. I mean, I think we're going to see much more pass through here in higher food prices, and food prices actually matter more. See you, Chris. We're almost done, by the way.
All right.
But you go ahead. Go do what you need to do. In the consumer price index, I believe energy, which includes the cost of gasoline and home heating and everything, is probably what, Ryan, 7% of the CPI, and food prices are, I think, 13, 14% of CPI.
Correct.
So almost twice as much. So this is very, very important, and obviously a big concern, around the world. Okay. Sorry about that. I knew that was a little hard, but
No, Marissa, that was impressive that you got
that was
one.
impressive, though.
That was
that was pretty good. Very
hat
good.
tip to you.
So you can tell she's a careful consumer of your work, Ryan, on economic.
Oh, I would never have gotten
Very
that.
much so.
Yeah, very good. Okay. Chris has left. I think we'll keep this a short podcast. There's a lot of other topics to discuss in the labor market. Maybe we'll keep them for next Job Friday. I think at some point we got to go back, talk about remote work. I'm curious what your thoughts are there on that and productivity. Talk a little bit more about the Great Resignation or reshuffling, what's going on there. We kind of talked around that, but not right to it. And, talk a little bit more about the wage dynamics and, what that means for overall inflation. So there's a lot to talk about, but we'll have you back and we'll do that. Before we sign off, Anything else? Here's another open-ended question for both of you. Any other things we should be talking about, or things I should be saying? I should mention, Sarah mentioned to me that I should let everyone know that we are going to have a bonus podcast. We've been having a few of these along the way here. And this one is to answer all of the listeners' questions. And we're going to have Emily Mandel, one of the other economists at Moody's, to help moderate that. So I won't be the moderator for that one. I'll be an answerer, if that's a right term. So we'll be doing that. But anything else, Ryan, you want to mention? Marissa?
I think we covered it.
We did? Okay. Marissa, we covered it?
Yeah, I think so.
Okay.
I mean, next time we can talk about, some of the special questions that BLS does related to the pandemic. They all improved
They all
between
improved
February
too.
and March.
Yep.
So the number of people that weren't able to work because of the pandemic, that fell. So we should make further progress in April.
Okay. We'll talk about that. We'll put a pin in it. Okay. With that, we're going to call this a podcast. Thanks, everyone. Talk to you next week.